Nick Sargen is Chief Investment Officer at Fort Washington Investment Advisors. He oversees roughly $40 billion in assets. He's with us this morning from Cincinnati. Nick, I'm sure you just heard Eric Schatzker, Michael McKee talking about the possibilities coming from out west this week. I know you want Ben Bernanke to hold QE3 apart. But what if we do see more and more evidence that we are going to be tipping into a slowdown, if not a recession, in the U.S.?
Well, Deirdre, good question. The reason, let me be clear, the reason I think he'll keep it in his hip pocket is go back a year ago. And, why did he say he did the second round of quantitative easing? At that point, we had inflation actually falling below 1% as the Fed measures it. And Bernanke was basically saying the worry then was a deflation fear. So he announced QE2 as basically an insurance policy against deflation. Now, what we all know now is it actually sparked a huge rally in the market, but it also boosted commodity prices, softened the dollar, and we saw, generally risk assets doing very well. So why do I think he's not going to say anything right now? Well, by the Fed's own measure, core inflation is in the 1% to 2% zone, and some feel it's moving closer to 2%. So he's got, as you've already pointed out, Treasury yields are at record lows. Are we doing it to lower them further? So I believe, he'll say he's got more options, but this isn't the time to begin QE3. And I point out he had 3 dissenters at the last FOMC meeting just on saying no rate increases for another 2 years.
Nick, what is the best strategy then, given these possibilities for the average investor? I mean, should somebody buy treasuries? Should they buy stocks? I mean, what do you do?
Yes. Right now, I certainly would not be rushing into treasuries because these are extreme moves. I mean, think of it. Treasury yields today are lower than during the Great Depression. They're lower than during the worst part of the '08 financial crisis. This is where I think people need perspective. Yes, things aren't looking good. The economy's at stall speed, but we're not as bad off as we were then. And that's why I think that Treasury yields can actually move higher once some of the worst fears are taken out of the market.
Once some of the worst fears are taken out of the market. Speaking of the market, getting to stocks, I know you have a somewhat unique call on the financials. It's a contrarian call.
Yes. Bottom line is we've had an overweight in financials, and I'll be honest with you, it's not been fun. That's for certain. But why did we do it? We did it because basically, if you look at all sectors of the market, and we're long-term value investors, this has been the part of the market that has just been clobbered, as you all know. So what I certainly do not want to do is be pitching out some of the names right now. We realize it's battened down the hatches, especially with the problems in Europe. In fact, that's the main thing I worry about is the European financial situation. But my view is that the markets are pretty much pricing in, again, almost a replay of '08, '09. And while I think things are not looking good, I just think banks are in much better position today in the U.S. side
to deal with some of the
absorb potential shocks. Yes.
Nick, we thank you so much.
Thank you.
Nick Sargen joining us there. He is the Chief Investment Officer at Fort Washington Investment Advisors.